Welcome, ladies, to the Real Estate Investor Show, providing inspiration, strategies, and insight to empower women investors to live balanced and financially free lives. Now, here are your co-hosts, Liz and Andressa.
Hey, ladies. So on today's episode, we have Amanda Han. She is a tax strategist, a real estate investor, author of 2 Bigger Pockets books on tax strategy. And we just had an amazing interview, like literally chock full of detail for all of you. One of the things I think you'll get a lot from her in terms of as she gets into it is we talked a lot about retirement accounts. A lot of women are at the point where they're getting ready to retire or planning for retirement. And it's a lot that can come at you. And we talk a lot about how you can, obviously, we know self-directed IRAs are a powerful vehicle for our world of investing, but she actually gets into really good specifics around when to lend out of your IRA, when to become an equity partner. And it's just really very strategic conversation around that was a really wonderful conversation. I think you're going to get a lot from.
Yeah, Amanda is super real, right? She's super real. It's not like you're a CPA, you do everything that you're like there. She's a person like you, Liz, and I. She also talked about short-term rentals, which is a big and common thing, becoming more common among investors. And cost segregation. It's a big word that we might think, oh, this is more for a syndication deal, large apartment complexes or commercial deals. And it isn't, right? And she talks about how you, in your small deals, you can apply that, and also the benefits for your passive investors. So you can't miss this. You can't miss this interview. I hope you enjoy it, and let us know your aha moments. And if you have any further questions, please watch or listen to it now and let us know how did it go.
So as we all know, negotiation is probably one of the most important skills you need to have as a real estate investor, whether you're buying, whether you're selling, talking to a homeowner, negotiating with the bank, negotiating with private money, negotiating with partners, the list goes on and on. Negotiation is the skill to have to be successful in real estate investing.
But the problem is a lot of women don't feel comfortable doing it. They don't feel confident going to a negotiation match, right? And so what we are thinking is, how can we provide you? We are here to serve our community. And our goal is to provide you the skill set that you need to be successful. And one way that we all do to gain that skill set is like listening to podcasts, reading books. And when I read Never Split the Difference by Chris Voss, I really understood the importance of negotiation. And we have a special event coming up tailored for you.
Yes, Chris Voss is the founder of the Black Swan Group, and we have one of his top instructors, Sandy Hine, who is a previous police officer, and she was a hostage negotiator. All right, so she knows what she's talking about when it comes to negotiation. She's providing a 90-minute live training for our community exclusively around specifically negotiation skills, and you cannot miss this event. It's March 25th at 7 p.m.
So click on the link below and save your seat today.
Welcome back, ladies. This is Liz.
And this is Andressa.
Welcome back to the Real Estate Investor Show. We have a wonderful guest on our show today, Amanda Han. Thank you so much for being on with us, and excited to jump into your story and all the amazing stuff you're going to tell our listeners.
Thank you. I'm so excited to be here with you guys.
Yes, Amanda is an investor. She's an accountant. She's CPA, everything, all things money. So we're going to get into a lot of good things in a moment here. But as we like to do, thank you for being back with us. Thank you for being on this journey with us. We'd like to say always on the road to financial freedom and doing it in a balanced way. So we always like to get connected to all of you. We can't see you physically, but we feel you. And we want to share something that's coming up for us. And then we jump into our interview. So, right, Andressa?
Yes, today's your turn. What do you have?
Andressa and I take turns because we have so much to just share that we have to
We beat each other to get a turn.
That's right. We arm wrestle. Virtually arm wrestle. No, we don't do that. Although my son likes to arm wrestle. So speaking of my son, that's what I wanted to share with all of you. Always good stories when I talk about my kids. But we got hit with a pretty big snowstorm here in the Northeast, and it came off of a weekend, right? So there's only so much TV and only so much TV and snow that keep your two young kids occupied. So with nothing else to do, I took out Monopoly the other day. And you gotta love Monopoly with two young kids, And my son's really getting into it. He's at the age where he gets it, right? So he passed the, where you get your salary, right? You passed the little, place that you get your $200 salary. And he forgot to say something to me. I said, Zach, I'm going to give you the $200 because it's your salary. This is the last time I will give you the $200. I'm not going to remind you about giving you the money. You need to remind me. And if you forget, guess what? You don't get the $200. Really, Mom? Yeah, I'm not in charge of reminding you about money. He goes, oh, okay. All right. Next time I'll. And so the next time came around and he reminded me. So I'll tell all of you this because it reminded me the power of playing games with children. We're all on this path of financial freedom, but we're all about creating legacy, especially women. And what better way to do that? I didn't know I was going to teach that point, right? But what a great point. What a great lesson and it was in the context of the game. And it wasn't like mommy's telling me what to do. I just was telling him the rules. I'm like, I'm not going to give you this money next time. I'm like, but and I thought about it afterwards. I'm like, what a great lesson, right? To start teaching him. You're going to lose money. Well, then you're going to lose money. That's on you, buddy. That's on me. And what a great way to start that with a 7-year-old. So I encourage you listening, right? Get Monopoly, get cash flow for kids. That kind of takes Monopoly on like steroids because it talks about assets and liabilities and all the good things that investors like all of us like to talk about. But it's such a great way, right, to get this conversation going. And, I'm like, oh, I just taught a little lesson. I didn't even know I was going to teach. I thought we were just trying to pass the time away, quite honestly. Right? So anyway, I just share that because it reminded me of the lessons that can come out of a playful game versus like, mommy's telling me what to do. So that's what I got for today.
I had a very funny story because my son by mistake broke our TV. And he's like, yeah, you can get another one on Amazon, right? I was like, oh, no. And everything for him is like $100. $100 is like, I think the top of the thinking process. I was like, oh, this costs $100. He's like, oh, $100. I was like, yeah. And he's like, how about like chores? I could do some chores and I get a coin. And then we started talking. I was like, yeah, you're going to do some chores and get coins. Here's the thing, buddy. Mommy's going to get the TV and you're going to have to reimburse me for the TV that you broke. And he's like, oh. So poor guy, he's getting like pennies and dimes.
You'll be 45 years old by the time you pay off that TV.
But here's the thing. He said, what's going to happen? This is like Lorenzo's first like thought process. What's going to happen? He wants to know what's going to happen. He said to me, what's going to happen after I pay you the $100 because I'm going to keep doing chores and I'm going to have more money. I was like, now we're going to talk about it, right? You can either save for a bigger toy or you can lend money to mommy and then I'll pay you for that. She's like, and he's like, oh my gosh, that's cool. What toy I'm going to get or, I was like, but here's the deal. You got to work hard, but you got to work very smart too. I'm not going to curse here, but the smart kid now is like, I did this chore here. I want 2 coins, not 1. I was like, what's going on here?
Yeah.
So now he's already thinking about like, okay, this is worth 3 coins, not 1 anymore. I was like, I'm creating a monster here.
That's exactly my 9-year-old too. He's a negotiator. So I have the same exact story where it's like, okay, you get, $1 here, $1 there. And then it's like, I think this is worth $5. No, maybe I should get $10. And I try to teach him, the concept of like you say, saving and not taking all the money and just buying a toy at Target or something. So I was trying to teach him the concept of, when you put money in the bank, you earn interest. So now he's on this crazy mindset that he said, I had $100 in the bank and now with interest, it must be $10,000. I'm like, sure, I like that bank that way.
And it's lifelong, right? These lessons just keep coming up and you kind of have to up the ante as they get older. So no, it's great. It's good stuff. Keeps us on our toes because why are we doing all this, right? to teach the next generation, right? It would be so sad to to my son to turn around and go, "What do you guys do? What do we do?" So without further ado, Amanda, thanks so much for being on, and I'm sure you have a lot of great financial, suggestions too with the world you're in. So share with the listeners a little bit about how you got involved in investing.
Yeah, good question. So I'm actually a third generation of real estate investors in my family, but it's an interesting story. So my grandparents, they were business owners, and like a lot of business owners, they have real estate on the side. And so when I was growing up, I remember I would help my grandparents with apartment turnovers. My cousins and I would go there on the weekends and, try to paint the house. It was so much fun. But growing up though, my family, my parents, my grandparents, they never really taught me to be business minded or to do real estate. Just the traditional route, I think, Liz, you said the same thing. It's just, going to school or, getting a degree, getting a good job, which is what I did. And I think like you guys, I was handed the Rich Dad, Poor Dad book, which was such a turning point for me to be looking at, this is what people do. And in fact, that's what a lot of people in my family did. But I was never taught to do that specifically, just really the traditional route of getting a job. And that's kind of, for my husband, Matt, and I, that was our first exposure to real estate. It just so happened at the time, we were both working for a big public accounting firm. And I was in the real estate group. So all my clients were doing real estate, and my job was to help them save taxes. But the strangest thing wasn't until I read that book where I internalized the strategies and said, hey, how come I don't do that? Before then it was just, this is my job to help other people do it. And then I go home and, that's the end of it. So that was how we first got into real estate. But I do remember our first deal was super scary. We, just didn't know if we were making the right move, and just all kinds of thoughts went through our head.
It's so funny, Amanda, because I read both of you guys' books. And the first one, when you guys saying, well, we are both CPAs working in this company, and then you guys start looking at your own tax returns. And there is this like pivot moment there. They're like, you don't understand what we did after we realized that. And I was like, what did you guys do? Yeah. And you're like, nothing. We did nothing. And I was like, wait a minute, they're humans too, right? So a lot of us investors, right? Because we're all putting on the same bucket. When we look at certain things, are like, oh, I should be doing something with this, or there's a better tax strategy if I do that. And you're like, yep. But until it's tax season that you got to deal with it, you're like, right. Right. But it was funny to hear your guys' story that it did nothing. So yeah. talk to us about that.
Yeah. And it's just a very honest story, because I think people sometimes will talk to me and say, well, of course, real estate is easy for you. You know the numbers. You've done this before. Even, your parents or grandparents did it. But just to share, we're just like anybody else, even starting out, even though we were in that industry specifically, it was still a shift of the mind for us to say, okay, well, we can do it. It does take work. I'm sure like you guys know, it's not just, I read a book and there I am. I'm just, now a real estate investor. And so it was the baby steps and really forcing ourselves. Because even at the time we realized that, hey, to be in real estate, to make a lot of money and save on the tax side of things, it does take hard work. And some of those things involved work that we were not good at. For example, negotiation. I said my 9-year-old's really good at it, but I'm not, and Matt's not either. So it's really making that decision to say, okay, this is very important to us to build wealth, save taxes. And so we'll take the action steps to really implement change. And, if I'm being honest, even today, I feel like there's more things that I could even do myself to save more on taxes or to do better in investing, because I'm around clients all the time who are doing really great deals. And we're working with clients on strategies to implement. But, do we implement all of those strategies? No, for us, even that's even baby steps too, to say, okay, well, our kids, are they old enough? Are we going to pay them this year? If so, how much? It's not just as easy as, okay, I know it, therefore it is, right? For us, to ourselves, we have to actually implement.
Yeah, no, that's so huge. And it's so much easier to give to support other people than sometimes to look in the mirror, right? Especially as women, I think we always have great things. So we were coaching someone on Jess and I last night, right? And the things we're saying to her, I'm like, I should take that. Wow, I have some good things to share. I should actually
write it down
to myself, right? Write them down and then make believe someone's telling me this. But anyway, so talk to us a little bit about your first real estate deal, and then we're going to get into some like specific kind of like financial questions, which I know our listeners always have tons of in terms of how to save, save legally on taxes from an investment perspective. So, but just briefly, just jump in if you don't mind your first deal and how you got involved in that.
Yeah. So our first deal, as I'm from Las Vegas originally. And so at the time, my mom was still living there. I have a good network of friends in Vegas too, that are involved in real estate. So when we first started, this property we found, back then it was in sort of a bad area. I don't want to say bad, but not a great area of Las Vegas. But it was in a gated community. So it was kind of a weird, thing that we found. And at the time, the property we purchased for around $70,000, which now seems like, so little. I know some people, we have clients who have cars that, they pay $70,000 for, but it was a nice little house that eventually when we sold it, I think we sold it for just under $300,000. And yeah, it was, it did really well, even though it was not in a good area. Our tenants were always really, really great. We were really hands-on because it was our first property. And, but yeah, so since then, so most of our investments are still in Vegas because that's where, I'm from and kind of where our connection is. But we are also invested passively in a lot of other people's deals as well, more on the apartment side, similar to what you guys do. And I love those. Those are passive for me. I don't have to worry about it. There's not much I have to do. And it's just larger deals that I myself don't have the time to kind of take down and manage and stuff like that. So, I think tax wise, we've always historically paid a lot in taxes. For me, it's a lot because I come from Nevada where there's no state taxes. And when I first moved to California, it was shocking. I didn't understand why a state would even tax me. It just made no sense.
That's right.
But the real estate does help us to alleviate some of that, over the years. And it helps us to, the taxes we save, we really try to reinvest that back into more real estate. Because like you were saying earlier, this is all for the family, for the kids in the future, because you just never know. We love working, we love doing what we do, but you just never know. One day, maybe we can't do it anymore because, sickness or family. I think for us, I know you were saying just about reading the book and how we did nothing. One of the main reasons we decided to take action was really going along that thought. At the time, my dad was alive then, but he was very sick. So I had to take care of him. And just the concept of being able to do that without saying, well, I have to either spend time with my dad or I would lose my job and just not have any secondary income was one of the main reasons that, for us at least, really made the jump to say this is very important for us to invest time to build our wealth.
Yeah,
absolutely. Absolutely. So one of the biggest questions, more frequent questions that we get all the time is about, all right, setting up an LLC for liability purpose. And people spend a lot of time and money creating this magnificent structure to protect them. However, they don't separate their books and records. And it's just like a big mess, all of that, right? So talk to us about the importance of separating your business from your personal.
Yeah. That's a great point to bring up because yes, that's probably one of the most frequently asked questions that we get all the time is, do I have to have a legal entity? And I think there's two ways to look at it. One is the tax side, and then one is the liability protection side. So I'll focus mainly on the tax because I'm not an attorney. So
sure,
if one of the listeners were to get sued, they wouldn't call me.
Yes.
But tax-wise, but I think tax-wise, one of the biggest misconceptions that we hear all the time is that people are told that you have to have legal entities in order to take tax deductions. So whereas, you might hear me talk about or read in the book was, oh, you can write off part of your home office that, all of us are working from at this moment, or part of your car expenses, certain meals, education, subscriptions to the investor clubs. And all those are tax deductible regardless of whether you have an LLC or not. From the tax perspective, all the IRS cares about is that these are actually business expenses. And by business, we just mean the business of real estate investing, whether you're a landlord or a flipper. It's just the real estate business, not necessarily related to LLC as a business. So I just want to make sure we clear that up, because I do have a lot of clients who are just starting out investing and they're like, oh, last year I spent money on this, and this, but I didn't have an LLC yet. I'm so sad. But no, you can still deduct it. They're business expenses, offsets your rental income. But I love the point you brought up about the LLC, because yes, my understanding and working with attorneys as well is that in order to get the asset protection, right, which is the reason you have an LLC, you do have to utilize it accordingly. So we have clients who form an LLC, and then there it is. It just goes on the shelf, the binder, and it's all pretty. And then that's it. They tell me they own an LLC. And then we say, oh, well, is it titled there? Do you have a bank account? So those are things that, not just form it, but actually utilize it by having a whole title to your rentals, having a bank account, getting the rents paid in there. Those are very, very important things that we unfortunately still see missed from time to time. So I think either you have an LLC and you utilize it correctly, or you don't have an LLC.
Mine as well.
Attorney,
just not do it.
Yeah. Or your attorney might say, hey, umbrella insurance is enough, or you have enough debt, or, everyone's situation is different, and not everybody needs an LLC owned by an umbrella with a management. And I know those are really great for certain larger investors, but you just always want to make sure you have the structure that fits your needs and not necessarily, I don't know, Robert Kiyosaki's need, right? We're not all rich dad here.
No, that's so true. And I think so many people want like the one fit size, like they want it to fit their, like, what's the answer to this question? But in so many ways, when you have your trusted accountant, you have your trusted attorney, they know your holistic profile. They know all of your assets. They know of your liabilities. They know everything that you're bringing to the table. In a way that no one else can give you that advice. Yeah, so I always say, don't dismiss talking to a professional that knows your situation and also knowing where you want to go. Some people just want to buy a rental and that's it, versus I want to buy, 50 units next year. Well, that's a little different, right? Different goal, different set. So that's excellent. So we have a lot of women who, are scaling their portfolios, right? They have a number of units, and they have an accountant, they're working with, saving on taxes, but they get to the point where there's just some nuances. What do you find to be the people that are scaling, right? Going from maybe a few rentals to a larger portfolio or growing their portfolio? What are the common misses that they do in terms of saving on taxes that they can think about as they, either keep working with their accountant or, work with somebody different, because sometimes you outgrow your accountant, which is a good thing to think about. But especially for the women that are scaling, what are the misses or what are the things they need to think about to save?
Yeah, I think as, for a lot of people starting out, right, maybe they have a job still or, just to stay at home and they have, one or two rentals here and there. You just, real estate is kind of a side thing. So if you're a married couple, your income is over 150,000, it means that, your rental losses can only offset rental income. And by loss, I just mean, depreciation, our home office, you can use all that to offset rental income, but it doesn't necessarily always offset taxes from your W-2 or other business income. And what we typically see with women who are scaling their business, going from, a couple to multifamily, usually that's in conjunction with switching sort of more time into real estate, right? More time in real estate, less time at a job, maybe, going part-time or something like that. So one of the greatest opportunities from a planning perspective then is to look at the ability to qualify as real estate professional for tax purposes. And when I say real estate professional, I don't mean becoming a realtor or a broker or anything. It's strictly just a definition under the IRS, depending on how many hours you're spending in real estate. But before we go over, what the definition is, let's talk about the benefit. Okay. The benefit of a real estate professional is that once you meet those hours requirements, then that means your rental losses, depreciation, all those expensing is not only used to offset taxes for the rental properties you own, but you can also use it to offset taxes from your W-2 and business income as well. So that becomes a huge benefit if we're saying, maybe, one person is a real estate professional. We have a bunch of write-offs you can do, but maybe the other spouse is a high income earner, a physician or an attorney. So now all of a sudden those two worlds come together and we can use the losses to offset all this tax from the W-2 income. So that's one of the, the main benefits or nuances I see when people are scaling up, but maybe they're not aware that that's even a thing, or maybe their CPA is not too familiar that that's a thing. But that's kind of a big shift to say, okay, well, now all of a sudden my two worlds are combined, and we can do more advanced strategies to say, wow, how can we create a very, very large write-off or loss on the real estate side to really, bring down our tax rate from maybe 35% to, 10 or 12%.
That's huge. It's funny you say that, because I feel when we were scaling and my husband quit his job, I was working, at the time I was working as a W-2, and then I transitioned to like a consultant, like a 1099, but I was still I was making all the money in our family. My husband made nothing for a long time. No, I'm joking, but he, we were growing a business, right? So I took one for the team. He took one for the team, but I just joke with him. I was like, oh, you're sugar mom. But anyway, we love
you, Matt.
Yeah, we love you, Matt. He doesn't listen to this show. It's okay. But it's funny because I remember sitting down with our accountant at the time, and they were, the one that we ended up firing and then transitioning to the one we have now was an enormous. And the first thing he told us, the one that we have now still that we adore, he said that. And he's like, Matt needs to be the real estate professional. He's in this full time. And Liz, you're making and that's you're going to get taxed very high for that. And the offset and you're scaling your, like that conversation we had with somebody who really knew what he was doing. And I remember the previous accountant and I didn't even hear that from him. And we probably paid quite a bit more taxes, at least 1 or 2 years. So it's just, you gotta work with the right, not all accountants are created equal, ladies. And just know that you want to work with someone who has real estate themselves. That's one point that I want to make. And two, that they're creative. Obviously the constraints of the law, right? We don't want somebody breaking laws or anything like that. That's not a good thing, but somebody who's creative, just to your point. And if they don't know what this even means, what we're saying, you almost like bad sign. So you can really shoot yourselves in the foot if you're not with the right people. That's all I wanted to mention, because I remember thinking that, and I'm like, oh, thank God we're with someone who knows what they're doing now,
Yeah, it's interesting. I go on Amazon and I read when people post comments or reviews after reading our book. It's just something I'm so curious. Like, what did you think? And I think just last week I was reading, middle of the night, I was just scrolling and I read someone said, oh, I read about real estate professional and how it could save me a lot of money. And I talked to my CPA and I said, does this work? And he said, yeah, it'll save you a lot lot of money. And she was like, I don't know why he never told me.
Why the hell you never told me that?
Yeah.
I thought,
I feel that's too late, right? When we are bringing to a professional, hey, would this work? Oh yeah, of course. We'll have saved you 20 grand, 30 grand, 50 grand last year. Oh, great. Thanks. Thanks for letting me know. So let me pick back on the concept of cost segregation, right? It's a big term. And reading the chapter about this, and some people, they can do by themselves, right? They can use softwares, they can use other things. Mm-hmm. My question to you, would you recommend people to do it by themselves? But before we go that, can you just break it down for the listeners? What is cost segregation and what are the tax benefits?
Sure. So, as real estate investors, we all get to take depreciation, right? Or as landlords, I'll say. And that basically is the IRS allowing us to write off a part of the purchase price of a building, because in their eyes, the building is going down in value as you use it. If you buy a computer, it goes down in value. So they feel like we buy real estate, it goes down in value, so you get a write-off for it. But of course, we all know that it, generally doesn't go down in value. So nonetheless, the IRS allows you to write off this depreciation regardless of whether your property is actually going up or down in value. And that's one of the biggest benefits is, you're taking a loss on a property, even though it hasn't really lost money. And that's what earlier when I said, when we have a bunch of losses on our rentals, it's most of that is from depreciation and expensing, not that we're actually, cash flow
losing,
negative, right? Yeah. And that's the first goal is to cash flow positive and then create a tax loss. Cost segregation is sort of what I call like a supersized version of that. So it's basically instead of depreciating the building maybe over 27 and a half years, you have a cost segregation firm or engineering firm to go in and break out the components of what makes up that building. So instead of just saying, hey, here's my office building, we say, well, within the office building, there's 30,000 worth of drywall, 10,000 worth of flooring, 6,000 worth of cabinetry. And after they do the breakouts, then your CPA can then calculate faster depreciation. So instead of writing everything off slowly over the next 27 years, we're trying to write off as much as we can this year or maybe over the next 5 years. That's been a very huge one, especially in the last couple years and even into 2021, because we also now have bonus depreciation, which means that for a lot of things, you can take 100% of the write-off immediately this year, rather than even having to wait maybe 5 or 7 years. And that's what we're seeing, industry average, if you have a property let's say that you bought a building for $100,000, on average, the cost segregation will get you maybe 15 to 30,000 of first year depreciation when you do a cost segregation. Of course, it differs depending on, where the property is and how many doors you have, but that's kind of a rough estimate on what the benefit is. But to answer your question, Andressa, we do not recommend doing like the do-it-yourself or the softwares that are out there. And the reason is that upon audit, IRS usually will speak with the engineers who did the cost segregation to make sure that they have the paperwork and everything's behind it. And if you're using a software, for me, I don't know who would be that person that they would speak with, right? So then it ends up being you or your CPA. And I can tell you, for me as a CPA, I know nothing about engineering. I don't know what is composed of any building parts of it. I like the decorating part.
Sure.
But the engineering part, I don't, not so much.
That's great. And I think with regards to cost segregation, it's not even sometimes a term when people are involved in like small multis. And I don't know what your opinion on that is, Amanda, but we really got more familiar with it as we scaled into larger buildings. It just made more sense on that scale. Do you find that people with small multis do it? Does it make sense? Because we only did it on when we started getting into larger multis.
So that's a great question. I'm so glad you brought it up because that's actually a common myth too. Most people feel that way, that cost segregation is very expensive. I only want to do if I have commercial real estate. Yeah. And that's not true at all for a couple of reasons. One, depreciation, as you guys know, is based on purchase price. Okay. Mm-hmm. So in California,
down
for
payment,
example,
which is another myth, right?
Exactly.
People think that that's based on the down payment.
Yeah. So in California, as an example, it's not, you can find single family homes that people are paying $1 million for. And so that by itself would potentially be a great project for cost segregation because we're working with the building portion of that $1 million purchase price. So that could be very significant. Or you can even be, somewhere maybe in Vegas, for example, when I had that property, it was, $70,000. So that would be when maybe it doesn't make sense because the building might only be 50,000 worth. So not much to start with, but essentially we're looking at the purchase price of the properties and also the portfolio. So we have clients who have 1 or 2 dozen rentals in Ohio, and by themselves, each single family is not a lot of money, but collectively it might be, $500,000 or $1 million worth of real estate. And so if you do a cost segregation on that portfolio, you could still get, 100,000 or more in terms of tax write-offs. So it is looking at, the entire portfolio and the purchase price of the properties. But the best thing about cost segregation is that you never have to, as an investor, you never have to decide whether or not to do it until you actually know whether it will benefit you.
Yeah.
Right. So the first step starts with the CPA. CPA is going to say, hey, Liz, because you're qualifying as real estate professional, because here's all your other income, you're still at a high tax rate. Let's look at your portfolio and say, which ones do we think might make sense? And then the CPA would send the information to the cost aggregation firm, and they can do a preliminary cost benefit to say, here's what I think it'll be broken out to. Not doing the study yet, but just what I think based on your address and the information that's available online. And then your CPA can come back to you and say, okay, Liz, here's what we found. You got 10 properties. If we do cost like on these 3 this year, you'll get 80,000 of a tax savings, right? Yeah. And the cost like firm might be charging you 3,000 or 10,000, right? And then you say, okay, does it make sense for me to spend 10,000 and save 80? Or does it not? They might come back and say, hey, Liz, for this property, you're only going to save 2,000 and the cost like fee is 3,000. Then we say, okay, no, that doesn't make sense. I'm spending more than I'm saving.
Yeah. And I would say too, what's interesting is that as we scaled our passive, so we were always work with a lot of, raising private money in terms of our how we got started, and a lot of passive investors over the years. And as we get into larger buildings, a lot of them would ask, right? Yeah. Are you going to do a cost segregation on this building, right? So sometimes your passive investors who could be somewhat either accredited, sophisticated, they're around, they know what's going on when it comes to large multis and commercial, they're going to ask you. So you want to be ahead of the curve, right? You want to be proactive and have already done your due diligence, right? They shouldn't be saying to you, hey, are you going to do cost segregation?
Googling
I'm not too familiar with that term, right?
No, while the person is asking, you're like Googling it, cost segregation. What is this?
Can you spell that?
Yeah, right. Because we ourselves, like we've kind of scaled quickly, right? So, sometimes when you do scale, you're going into a different, threshold, right? You're building out your team, especially as you get in from a 10 unit to a 50 unit to a 200 unit, right? The scale has now just increased. The game has gone from like minor league to major league. So just know that, right? You want to be ahead of your passive investors, but I can tell you, especially when you're doing deals that are have like a 3 to 5 to 7 year turn, right? That, in other words, you're returning these investors' money in a very short time frame in the building that gets churned, so to speak. It's not a 20-year hold when you have a lot of investors in those types of projects. They really want that because it's accelerated, right? They're not going to own it 20 years with you. So, right. so in nature, right? And again, I'm not an expert at all in this, but I just know from an investor perspective, it really has become a really positive thing for them, because then it's they want to show that negative K1. They want, because they're high paid professionals, right? They want those returns so they have something to reduce their tax bracket. So to your point, don't just think of yourself, especially if you're going to be raising money, you're going to be working with passive investors, you're going to have equity partners. Keep in mind, it's not just your own benefit. It's theirs too.
Yeah. And I'm so glad you brought it up, because that is certainly a thing we see. Because I think for us, we see it from both sides. We have clients who are passive investors in syndications, myself included. Yeah. And then we have clients who are like you, who, you guys who are syndicators. And so, yes, I do think there's an expectation that there is going to be a large write-off or, some K1 coming through. So yeah, sometimes we'll say, hey, ask your syndicator, are we expecting a cost seg? So yeah, I think some of these times your investors, the questions are probably coming from their CPAs,
right.
Say, hey,
it's probably not, exactly. Yeah. It makes it sound smart though.
So Amanda, I want to switch gears here and talk about, short-term rentals. This is like a quote unquote new concept, right? I started in 2012, but a lot of people still familiar. Oh my gosh, can't pronounce that. Jesus Christ. Getting used to, let me change.
I love when you curse. I love when you curse, Andressa. Makes my day.
Gosh, see, for those of you that are listening that are bilingual, see, you don't even need to speak English right to work in real estate. Here we go. So for the folks that are just getting used to the possibility of investing in short-term rentals, but they are not completely, aware of the tax benefits. How does this compare with a regular rental? Is it different? Is the same thing? Or how, from the tax perspective, what are the tax treatments for short-term rentals?
Yeah, great question. Great question. And we have so many clients in short-term rental space nowadays. It's just blown up so exponentially. I'm sure you guys have seen that too. So tax-wise, a couple main things to mention. If you're someone starting out in the short-term rental space, we touched on earlier, right now, this year, there's still 100% bonus depreciation. So as short-term operators, I'm assuming most of you are furnishing your properties. So all that furniture and fixture and TV appliance, all those are eligible for bonus depreciation. Okay, so keep that in mind. And when you're sending your information to your CPA, don't just say, oh, I spent $10,000 for the short-term rental. Let them know how much of that was for furniture, how much of that was for, the supplies like silverware and things like that. So they can take as fast depreciation write-off as possible if that's going to help you reduce taxes. Now, there's a couple different treatments of short-term rentals. One is where, for tax purposes, it's treated like an active business, similar to a hotel. So the downside of that is not only do you pay income taxes, but you also would be paying self-employment tax or payroll tax, just like a W-2 job, right? And the reason is they're saying, hey, it's a business. You're doing more than just renting stuff out. You're also providing services like food and beverage or pick up and drop off at the airport. And so that's the active business bucket. But to be honest, we don't have any clients at the moment who are in that bucket. Okay. Most Airbnb people are just where, they come in, when the guests leave, 3 days later, we'll go and change the sheets. We might have some maybe salt, pepper, and water, but we're not providing any meal service, right? They can't call me and say, hey, Amanda, I need this, this, and this. Well, that's a vast majority of Airbnb. And so in those scenarios, it's just treated like any other rental income, in that you don't have to pay that additional self-employment or payroll tax. And again, this is where the vast majority of short-term operators is in that where, it's less than 7-day stays, but we're not offering all these additional services. So that's the second, main part of short-term rentals. And then the third benefit of short-term rentals, and this might be very beneficial to some of you who are doing real estate, but not necessarily a real estate professional yet, where real estate is not your full-time job, but you still also have another full-time job. So if you have a short-term rental where you materially participate, and we'll define that in a moment, if you're materially participating in your short-term rental, it means that the loss from your short-term rental, okay, with depreciation and all that, can be used to offset W-2 and other income, even if you don't qualify as real estate professional. Okay. So if I have a bunch of long-term rentals, I have a short-term rental, and I'm not a real estate professional, but if I materially participate in this short-term rental, I can do a cost segregation. I can do as much write-off as reasonably possible, and that can be used to offset taxes from my W-2 and other income. So material participation, unfortunately, is not something I can super easily explain, but I'll tell you, there's 7 different requirements and you just have to meet one of them. We'll touch on 2 of them because the 2 most common ones, the other ones are sort of very technical and boring. So the 2 most common ways people qualify for material participation, one is that you spend at least 500 hours in the short-term rentals during the year. And that includes a spouse. Okay. So if it's Liz and Matt, both of you guys spending at least 500 hours, and that's acquiring the property, dealing with management, doing turnovers, all those kind of usual real estate stuff, at least 500 hours, you meet material participation. Okay. And you can combine your different short terms. So if you have 2 short-term rentals, you can combine them and say, oh, collectively, we've spent 500 hours on these short terms. So we are materially participating.
Is it on or in? Like, because you actually could stay there and that qualifies?
Oh, no. So spend time on the properties. So not your time like vacationing there.
That'd be great if that's
the case. Let's just go try.
Right? But you're not saying that. Okay, so to be clear.
I like how you think.
Yeah, like how I think, right?
Yes. So, spending the time on the property.
On it, okay.
Managing, rehabbing, staging, getting it ready, okay, and operating. So you can combine the short-term rentals to get the 500 hours if you wanted to. The other test for material participation, if you can't have 500 hours, okay, the other one is that you spend at least 100 hours during the year on the property. but you spend more time than anyone else. So meaning no one else is spending 500 hours. We typically see those where it's, sort of like a self-managed short-term rental, where there's not too much to do, but you're kind of the person doing it. That one is a little bit more tricky. I know it sounds very easy. Hey, just 100 hours, it should be easy enough. The definition of other people, though, does include people that you hire. So that means if you hire a cleaning crew, landscapers, we have to count their time as well. So you have to spend more time than they do when we look at that 100-hour mark. But yeah, the benefit is, again, if you meet material participation in the short-term rentals, it's kind of a loophole, right? Now you can use all your rentals, the short-term at least, to offset W-2 income without being a real estate professional. And that's been very helpful for our clients who maybe are still working full-time, but starting to do more and more real estate, but not necessarily haven't quit their job yet. So you can't really be real estate professional. So that's been one that's been really helpful to some short-term investors.
Love it. I love
Awesome.
it. The other question I have for you too, as the pandemic, through the pandemic and COVID and people at home, obviously like some of the offices, right, closed for months, and many of them are operating in such a different landscape right now in terms of people working outside the home. Have they changed or updated any of the kind of like rules, if you will, or what you can write off from a home office perspective? Because I'm like, they really should, quite honestly, like I should be able to write off some of my mortgage right now. Like that'd be awesome, or the treadmill that I just bought for my house, because it'd be like a gym in my office, right? But I don't know. This is a question I need to ask our accountant too, but that popped in my head the other day. I'm like, this should change. This should have gotten updated. So have they updated anything through COVID and what you can write off, and any sort of more, they opened the floodgates a little more?
Yeah, that's a great question. One that we're getting a lot in this past year.
Yeah.
So I would say, so there's a couple different things to look at. One is home office as a real estate investor. Okay. So as a real estate investor, whether you're a landlord, flipper, short-term rental, if you have a home office you're working from, you can take a write-off, part of your interest, your property taxes, utilities, all that good stuff. You can still write it off against rental income. And again, if you're a real estate professional or, a short-term operator, you can potentially use that to offset W-2 and other income, right? That's always been the case, continues into 2020 and 2021. No changes there. Okay. They haven't given us added benefit, but it's basically all the same benefit that we've had in the past. Back in 2018, the last major tax change, the government took away the ability to write off a home office for our jobs. So if you're someone who's working from home for your job, which is most of us, right? Because employer says everything's closed, you can't go in, everybody's working from home. Right. Before 2018, we could write that off. That was an expense against, to offset income. But starting in 2018, that was no longer the case. They took away the ability to write off a home office to offset W-2 income. And unfortunately, that has not been changed. That has not come back. As of today, the law still is we cannot write that off against W-2 income. Yeah, which is super crazy because that's the majority of people, at least in the US, is we're all working from home. And a lot of times your employer is not reimbursing you, right? The employer is not saying, let me pay part of your mortgage because now you're using your own, lights and utilities and all that. We're hopeful that will change. There are talks that is potentially going to be changed. Now, the main question, though, is when will be in effect? Are they going to change it retroactive to 2020, hopefully?
Sure.
Or will it be maybe go forward? So that's part of the unknown, as we're already in tax season, and that's one of the biggest questions. But unfortunately, the law today is that, you can't write it off. But I do want to say something that I think is a kind of a common mistake we see from investors. You were mentioning like, okay, so now I'm working from home. And, for the home office, we can take a portion, right? We take a deduction for part of the interest and taxes and utilities and cleaning and all that, right? That we pay for. We take a part of it because you're not just cleaning the office, you're cleaning the whole house. It's mortgage for the whole house. So it's a portion. But there are things that are specific to your home office, which we take 100% deduction for. So things like, if you have a telephone line specifically for the office, or if you buy new computers and laptops and just furnishing for the home office, those are actually 100% deductible. Even though it's part of your home office, it's not really a home office expense. It's just a regular business expense, like how you need furniture to operate your business, how you need a laptop to operate your business. Those are actually just regular business expenses that you can take, whether or not you claim a home office, right? So we have people who, can't claim a home office because they don't actually have one, but you can still write off a lot of these expenses because you're using them for your real estate investment.
That's awesome. So we have on our community a lot of ladies that are already getting ready to retire or already retired and are enjoying their life. So they're looking to invest in real estate. How can they supercharge their retirement accounts? What are your top tips?
Retirement money. So yeah, I think if you're someone who, well, let me take a step back. So IRS has always allowed people to choose what to invest in with their retirement money. But I know traditionally we always hear about stocks, right? Retirement money is in stocks, mutual funds, bonds. Everybody knows that. Not a lot of people talk about using 401k or IRA money for real estate because usually the brokerage firms are the ones who controls your money. And of course, when you move it to real estate, there's no commissions on their end. So no one's really advertising that ability. But the IRS has always allowed people to use that money for real estate or startup companies or even notes, right? Syndications, note investments, those are all things we can invest in. But for a lot of people who are working full-time still, sometimes the employer might have some restrictions, right? Might say, okay, Andrea, so you're still working here as a W-2, so you can't move your money yet, right? Although IRS says you can, but I'm saying you can't. You can move it when you retire, when you leave. And so for these ladies that you're talking about who are ready to retire, close to leaving their job or something like that, that's a great opportunity because once they leave employment, now that 401k that they've been building up for all those past years is freed up. So they can say, okay, let me move this over. I'm going to roll it out of Fidelity or, wherever it is into a self-directed account, self-directed IRA or self-directed 401k. And then from there, you can use that to buy a rental property on Main Street or invest in a syndication deal with Liz. So then you open up the doors to say, wow, what are all the things that I want to invest in, right? Could be notes, could be rentals, could be syndications. And when you do it that way, it's not a taxable event because you haven't taken the money out of the retirement account. You simply changed it from Ameritrade or Fidelity to a self-directed retirement account, both still within retirement account and growing tax-free or tax-deferred.
Yeah. And those folks really make such amazing passive investors, especially the ones that are real estate friendly, if you will, and they want to invest in real estate. They've been our, just go-to people because lenders or equity partners, quite honestly, they can lend out of the self-directed or actually become a partner long-term. It really, either or, it doesn't matter. So it's a great opportunity for the women listening to think about people that that like and respect you, to think about how they can lend to you or work with you through their self-directed. It's such a great vehicle that a lot of investors don't always, I think a lot of them do think about, but especially as you look for private money, it's not always the go-to place. We think of cash, we think of an uncle or aunt that are just got tons of money. Yeah. But it's the self-directed or the folks that actually are looking for ways to get better returns because they've taken more ownership, right, of their money versus just letting it park and get crazy low percent they get from funds.
For the syndicators, you're exactly right. I mean, for our syndicator clients, I know a couple of years ago, before COVID, right, when we had events and you can see people face to face, I always tell them, those self-directed custodians, when they hold educational events and mingles, those are great places to go because it's people who are saying, gosh, I want to get out of the market. What can I invest in? From a syndicator's perspective, we call that patient money, right? Because, someone gives you cash. A lot of times they're like, where's my money? Where's my return? But if they're giving you retirement money, hey, it's money they weren't counting on spending anyway. So, they put in this deal. When you exit, they'll put it in your next deal, right? Yeah. And so it's an easy way for that to become kind of perpetual investor funds that, you just keep getting over and over again, as long as you've been good at keeping your promises. So I think from a client's perspective, for our clients who are looking to invest their self-directed money, one of the tips I tell them is, if you're interested in note investment as well as real estate, right? So I'm going to either be a lender, I want to be a lender as well as an equity investor. I would say try to be a lender first from your retirement money. Okay, if you're doing both, right? Not that one is better, but if you're doing both, lend from your retirement money. And the reason is, as a lender, what you earn is interest income. Interest income is taxed at your highest rate if you were to use your cash for it. And so in the retirement account, it's protected, it's tax deferred, right? So we don't have to worry about taxes until later when we take it out. The second reason is, as a lender, we don't get the write-offs, right? As you know, like equity investor, we get depreciation, cost segregation, we get all this. And so we want that. We want those losses flowing to us. And as a note investor, you don't get depreciation. You have no expenses. You have no write-offs, right? It's great money, but there's no expenses to it. And that's why it's good for a retirement account, because I don't care that there's no write-off or expenses because it's tax deferred anyway, right? So just might as well use retirement money for that. So something to think about if you're someone who wants to do both. I have money, I want to do some notes, some hard equity, then maybe consider the IRA money for notes first, and then using more of your cash for syndications. If you don't want to do notes, of course, then it's perfectly fine to use retirement money for equity in syndications too.
Yeah. And that's why you need such good counsel, right? So if you're like, this is the investment vehicle that I want to invest in, or the asset I want to invest in, and this is the assets I have access to, right? Self-directed, cash, equity in my home. You might have all three, and you have all these opportunities. To your point, it's not all created equal. I love what you're saying, because it's such a strategic conversation. This is not like a go do this, So love it.
I love all those things you named too, because sometimes I meet investors who will say, I really want to do real estate. I don't have the money, right? And they're just looking at cash in a bank, but they're not looking at, I have all this stock that I could sell. I have all this equity in my other properties and retirement account. So all of a sudden it's like, oh, okay, no, I do have a lot of money too.
Sources of cash. Yeah.
I didn't have my cash in the bank, but there's all these other things that, we call those lazy assets, just kind of all these other assets you have that's not doing anything. It's just being lazy and you don't even know it's there.
No, I love it. I actually just taught it's fresh in my mind, because I just taught we have a growing membership through the investor community. And I just literally recorded a video for our membership. So that's fresh in my mind, because I literally just taught it the other day. But without further ado, Amanda, why don't you let the listeners, women listening, learn more about you, connect with you, just share where they can reach out with all your great insight and everything along those lines.
Yeah, I think for any listeners who haven't read our book, I highly recommend it, of course. It was very well written by me. Matt and my husband Matt. Yeah, and I'll give him a little bit of credit. But you can find it on Amazon. It's called Tax Strategies for the Savvy Real Estate Investor. And I think what I'm most happy about for the book is that it's written in story format, and the feedback I've gotten is that people actually enjoyed reading it. Whereas I think most people feel like, that's just pulling teeth to read a tax book. It's like the last thing you want to read. So I highly recommend that people check that out. The best place to find me is our company website, which is www.keystonecpa.com. That's KEYSTONE CPA.com. A lot of people think we're in Pennsylvania because of Keystone.
That's funny.
I get that all the time.
And you have a free gift for our community?
Yeah. So actually we have, so on our website, we have a lot of great free resources, but we also have a free ebook that you can download from our site. If you just go to the site, you'll be able to access that. Awesome. And we try to put, new content on there as we can. I do think 2021 might be a year of some potentially significant tax changes coming down the pipeline. So if that does occur, I would love to come back and give you guys the latest.
Absolutely. So all this information you guys can find on our show notes. Now we're going to transition to our fabulous 3 questions. And the first one, Amanda, is what's the most transformational book you have ever read?
I think it goes without saying that, Rich Dad, Poor Dad is probably the most transformational for me. Just in all the things that I talked about. But I know a lot of people probably say that book. So I picked a second book. It's a lesser known book. It's called How to Build a Business, Not a Job. And I think, Andresa, you'll probably love that, because I know you're all about scaling and systems and things like that. That has been really one that I read a couple years ago, and I try to read that every year or two because it really helps me to look at both my CPA practice as well as my real estate. on, how to make sure I have systems in place because, I think like a lot of other people too, the job in investing in real estate is to get the financial freedom. So freedom for time as well. And so everything we do, we want to be intentional about how to create systems so that it doesn't become, another job that you dread going or that, it suffers because you might not be able to be there because of family commitments and things like that. So
I love that.
That was very transformational for me just to think that way. Because, again, I was brought up to be an employee like most people,
Yeah.
And on some days I still am, unfortunately on most days, especially
we gotta
season, I'm an employee.
Unlearn, right? It's just like unlearning it.
Yeah.
The second question, Amanda, is what's the most transformational routine? No, what's the most powerful routine that you do to create a financially free and balanced life?
I don't know if it's super powerful. I probably a lot of people do it, but so I don't actually have a to-do list. Everything I do, I put it directly on my calendar. I'm sort of like I don't know, I'm a control freak when it comes to my calendar. So when I schedule things for my kids, like I block off time for my kids, now with homeschool, I was telling my friends, I am my son's friend at recess. So at 9:30 every day is recess. We go outside, we play handball, we play tennis. I mean, albeit it's only 15 minutes, and so I carve that out every day on my calendar. So if any of my clients are listening, that's why there's no appointment like early in the day for me because that's a recess time. And it helps me, I think, with work too. It's like, hey, I know I got to prepare for the investor show. So yesterday I blocked off a chunk of time just so I know, okay, here are the things that maybe you guys want to talk about. And so instead of having a to-do list, for me, I find it easier because my to-do list, I'll never get to it. Whereas it's on my calendar, when the time comes, I'm doing it. This is it. This is on my calendar.
That's awesome. And last question, which woman, famous or not, has inspired you the most?
I have to say, gosh, I know there's so many inspirational women just all around us. But I think for me, one that just stands out now is my grandma, who is she's 91 now, 91 years old, little old lady, never went to school, essentially no education at all. And she helped my grandfather build a very, a very good business in her lifetime. And in the meantime, she also raised 5 kids, or 5 boys and 1 girl, actually 6 kids, 5 boys, 1 girl. And by the time she was my age, in her early 40s, she was already a grandma. And she's still with us today. She loves seeing us, a bit difficult in COVID, but just, very inspirational how you just can come from nothing and build this whole legacy of, business as well as family. She's still the matriarch of our family, even though she's like over 90 years old. She binds like our whole family together still. So
that's awesome.
Amanda, thank you so much for being on our show. Thank you for sharing so much of yourself, your knowledge, and what you've, learned over the years with our community. So thank you so much.
Yeah, thank you. So fun. Thanks for having me.
Of course. And we are looking for the new, hopefully the soon new tax breaks transformation that you can come back and let us know.
Yeah, I was happy to do that.
Awesome. Talk to you soon. If you enjoyed this podcast and want to receive updates on our next interviews, go to our website, therealestateinvestor.com. There, you can subscribe to our show, become part of our investor community, and get updates on upcoming episodes.
If you like our show, please share it with other women who would benefit. And don't forget to leave us a rating on iTunes. We'd really appreciate it. And as always, we encourage you to take one action as a result of today's show and put it into motion so you can live both a financially free and balanced life. Thanks for spending time with us.
Ciao.